Good morning, good evening, good afternoon, whatever time it is for you, wherever you are right now. And welcome to another session of Bizarre Financing. I'm Gordon Bizarre, and today our topic is the questions that people were kind enough to email to us. And we prepared them so that you would have an opportunity to see those questions and for me to answer them. And hopefully you'll find those answers helpful. They may even trigger some new questions that you might have. And if that's the case, wonderful. And if that's the case, we'd like you to type those new questions into that side panel on the right and raise your hand if you want to ask your question on or comment live, which I love because I love the interaction with you guys and gals. And any unanswered questions, just send them to question@bizarrefinancing.com. And that's how these questions that you're going to see and get answers to today came about. So here's the first question we're going to address today. Is what is the role of an attorney throughout the acquisition process? I guess people hadn't used attorneys before and had that question. Well, what do they do? Let's take a look at what they do and what they should do, in fact, and what they shouldn't do. So the first obligation that they have, or the first thing that they're going to do, is they're responsible for drafting and reviewing agreements. So whether it's your attorney as the buyer that's drafting the agreement with the seller attorney reviewing them or vice versa, that's the first part of it. And what they'll end up doing is probably talking a lot to each other in legalese that gets the two attorneys to agree on the proper wording for different provisions of the document. And as long as your attorney is happy, you should be happy. And the same thing is true for the other side. That's their job, is to make sure that the agreement reflects in legal language what the intent of the seller and the buyer are. And so you're going to want to dialogue with your attorney so he understands or she understands your intent, and that they will also dialogue with you regarding the trade-offs between business risk and protection. Because your attorney can draw a 50 or 100-page document that protects you every way from Sunday, but that doesn't mean that the other party will sign it. It's too onerous to them. So there are certain risks that you end up assuming not being protected in your document, and the ability for you to assess the business risk to you is your job. That's not your attorney's job. It's your job, but it's your job to dialogue with your attorney to get them to where they can put into the legal language what needs to be there to protect you, but doesn't include what is not an appropriate business, what is an appropriate business risk for you to assume. Otherwise, you'll never get your document signed. So that's the process. And the third item here is to give you, as their client, legal advice and options. In other words, to tell you what's legally possible, what's not legally possible, how to accomplish something legally, what something might need to say to do it legally, what the options are, all of that very viable conversation to have with your attorney. It's part of how they get the documents drafted correct. But here is the kicker for a lot of attorneys who think that they're somehow now experts on business. Their job is to absolutely abstain from giving you business advice. When it came to legal documentation, they went to school for several years to learn how to draft the documents, what the law says, what it has to say if it's going to protect you, the proper way to word the document. See, they've learned all that stuff. They're an expert in that. They were trained, and as long as they've been in practice doing this, they've now had experience, which they've learned from as well. But they didn't get the degree in business operation or business buying and selling. That's not what they got their degree in. Okay. They weren't trained for those things. They don't have any reason to have any more expertise in that than you do. And probably if you've been in business any length of time, you probably have more experience there in the operations and all of that than they do. So you cannot count on them, and you shouldn't rely on them. When you get in a bad position with the other party's attorney is when the other party is accepting business advice from their attorney who doesn't know anything. And then it's problematic. Okay. So please keep these things in mind, because this is what their role really is. And if they're performing their role properly, they're staying in their lane, the lane that they've been trained for. The next question that we had, oh, and by the way, when you have questions on any of these, just write them down in that side panel. So at the end of the meeting today, we'll try and get to them, especially since we're going to be behind. I want to get in time. I want to get through all these. What is the CPA's role throughout the acquisition process? Okay. Their job is to review the company's books and records that you're going to buy and validate their efficacy. So they're the experts on financial documentation and books and records. That's what they've been trained to do. And you're going to rely on them to, as the experts, to review those books and records and to validate their efficacy. They're going to do, unless you curtail them from doing it, they'll also do for you what's called a search for hidden liabilities. In other words, there are tests that they can do on the financials of the information of the company that give clues to whether or not there are liabilities that the company has that have not been reported to you or they're not reported on their financial statement. Very important because you don't want to buy a company only to find out it owes money you didn't know it owed. They're also going to advise on the company's financial condition. They know by reading the financial statements whether that company is financially healthy, whether it's got too many liabilities for its assets, whether it has a ratio in their financial statement that shows that they're not really able to meet foreseeable debts coming up in the future. See, they know all that stuff. They've been trained in how to read all those financial relationships and ratios. And so they can advise you on all of that. They can help set up appropriate books and records, accounting processes and controls post acquisition. Because maybe the company you're buying doesn't have the greatest books and records in the world. Maybe they don't have accounting processes in place that give the owner a true insight on a real-time basis into the performance of the company. Maybe the owner doesn't have good controls because they just do everything. And so they don't worry about controls. But when you run the business, you're going to want to have hired people to do some of these things. And you don't want them running off with your money, right? So there have to be controls in there that make sure that doesn't happen. They can help you with all that. Okay. The one thing that they are not able to help you with is business advice. Accountants, frankly, are the worst business people on the planet. They are overly conservative, risk averse. They will not take risk for their own account and unlikely to in they're unlikely to advise any business decision where they see any risk at all. So if you take your advice from them on business, you'll never do anything. You'll never make a profit. You'll never have a business that grows. You'll never have any of those things because they won't permit the risk or advise something positive when there's any risk involved in the growth of the business. You're the business person. You have to make those decisions. And after you've gotten the advice from your CPA with respect to these other things that we gave you here, this is all important. And it's important to have your accountant for that. But you don't want to rely on them for business advice. So again, hopefully that's clear. Now, the next question that we had was what happens at closing? Not a lot of people have ever had a closing. They had a lot of openings, not a lot of closings. And so the question comes up, well, what goes on there? What happens? The way most of these are done. The people don't actually show up anymore at a closing. There was a time when you literally all met at some attorney's office or somebody's office. Everybody brought everything with them and documents got exchanged. It doesn't happen anymore. Okay. There's an escrow holder, usually either an escrow company or a bank trust department that handles all of what you're going to hear here. They're the holder of everything. So it'll start out with they'll get a set of escrow instructions that are signed off by the seller, by the buyer, and are usually prepared and negotiated through between your attorney and the attorney for the seller. So they'll come up with the escrow instructions that tell the escrow holder exactly what to do with every single piece of paper that they're going to get, and then what to do with that paper when they get it and how to close it out. Okay. So all those will be in the escrow instructions. There'll also be a documentation that comes in from perhaps a title insurance company, depending on what kind of property is involved, especially if you have lenders, they're going to definitely want all that stuff. All the agreements signed by all the parties come into the escrow holder. The cash from the buyer is put in an account held by the escrow holder. The funds from investors and lenders go into the account of the escrow holder. All that money's coming in because remember that escrow holder is somebody everybody trusts. Everybody has the belief that whatever those escrow instructions say, that escrow holder will faithfully follow those instructions and deliver out to everybody what they're supposed to get once everything has been given to them. They're going to take in all of your transfer documents, all signed off, the titles all signed off. Everything that has to be signed off comes into them. The next last aspect of what they do is there's a distribution of the documents to all the parties we're supposed to get originals and copies. And then there is an accounting of all the money that came in, all the expenses that were incurred, all of the distributions that were made to all of the various parties. It's reconciled so that everybody knows what came in and where it went out to. And then that's it. The accounts are closed. The documents are given to you. you end up with documents that are your titles that show you own everything. That's the agreement on how you got it, what you paid for it, all that. So it's all there. You got everything that you're supposed to get. And every party on this list here got what they're supposed to get. So that closes it out and everybody's leaves and goes about their business from there with the new arrangements in place for ownership and operation. So again, you have any questions on that, just put them in that side panel. We'll get to them at the end, but that's what a closing basically looks like. What questions should we be prepared to answer? Okay. When you're a buyer, you're going to get questions from a lot of folks. So here are the questions that you're going to get from various people. Okay. Who are these people that are going to want to ask you questions? You're going to get questions from a business broker. You're going to get questions from a seller. You're going to get questions from a lender who you want to loan you money to do this. You're going to get questions from an investor who you want to invest in your company that's going to purchase the seller's business. And the question they're all going to ask you is, how much money do you have to put down? Okay. And that's where normally most people would just sit there and go, aha. And that's not the answer you ever want to give. So the answer that you want to give to all those folks who ask you this question is, my partner and I can, and then whatever your number is, put down $500,000 or $750,000, whatever you've asserted or identified as what the down payment money is going to be. And the reason you always want to assert your partner in you is because at the end of the day, the reason you would have been hesitating to answer this question is we're going to assume that you don't have any money to put down, or maybe you have some, but it's not much and it's not near enough. But the key is you also know bizarre financing, right? That we have ways that if you've studied all of our material, you're not going to have to put down money of your own. It's going to come from other people, but nobody wants to hear that. Okay. Because if the business broker hears anything like you don't have money to put down, he'll ignore you because he earns a commission and it has to come out of the money you put down or that somebody puts into that escrow into the down payment column. The seller wants to know because he wants to know if you're real. Same thing as the business broker. The lender wants to know because they don't want to have more skin in the game than you do. They want you to have your money in at a certain level so that you lose your money ahead of them if things go wrong, which is your incentive to never let that happen. And that's also true from an investor as well. So the first thing you have to learn to do is to finesse the question of how much money do you have to put down? Okay. And the way in which you would find that if you've gone through Bizarre Financing Pro is you would get a hold of what's called an RMA annual statement studies, which RMA stands for Risk Management Associates. And by getting that, you would know or be able to figure on a company of the size you're buying or looking at buying, you would have the ability to know from its ratios how much assets it has, how much liabilities it has for the sales size it is. And once you know that, you'll know how you're going to leverage those assets to come up the money that you need to buy the company. And so you would know from the RMA studies or your evaluation analysis of it relative to your company that you're buying for that industry, you would know about how much money you'd be able to leverage out of the assets. And that will become the amount of money you can put down on the company. Okay. But you're not going to ever educate any of those other people up there to that process because it will give them an idea that you don't want them to have. Okay. You want everybody to look at you as a real buyer of a company. And you're a real buyer, not because you have the money in your account, but because you're financially savvy and you know how to leverage it to get it into the escrow account. Okay. So that's the answer here. And it's a very important one. There are other questions that these people would also ask you. And the business broker is going to see his question is going to be not a question. It's going to be, let me see a copy of your financial statement. Okay. That's not a question that you want them to ask you. So one of the things you want to learn to do in this process is to preempt the business broker from asking you to see a copy of your financial statement or from even asking you how much money you have to put down. So I will tell you categorically, in the last 50 years, not a single business broker, not a single seller, not a single investment banker, not a single lender, not a single borrower, not a single investor, nobody has asked me those two questions. How much money do I have to put down? And let me see a copy of your financial statement. And the reason for it is I preempt that in the way I present myself to them. I present myself in such a way where they presume I'm a qualified buyer and they give me everything I need. Now, I don't recall that we really covered that at great length in Essentials, which you're all members of Essentials. There are pro people on the phone too. And I know for a fact, cover it in great detail there, exactly how you do that. But I'm pretty sure that in my example of how I bought my first company, where I didn't have any money to put down. I didn't have a good financial, I had horrible financial statement. So I'm 99.99% positive that if you review the video on my first purchase, that whole Essentials video, you'll see exactly how to finesse those two questions, financial statements and how much money do you have to put down, which are the key questions they all ask you. Okay. You'll see how I did it and how you can too. Okay. Here's a statement before a question. He says, I've been looking at businesses on buy, sell, and notice some businesses are selling without the inventory and would have to be bought separately, meaning the inventory. Is this common? And the answer is no, it's not common. If the inventory is not part of the sale of the business, how can you evaluate the business? First of all, you can't. Okay. And I'll tell you why you can't. If the inventory does not either come with the business, or if when you add the inventory costs to what they're asking for the business, that it doesn't make sense, simply pass on the deal. Okay. And the reason is if the inventory is not going to be sold to you, you are not buying a going business. You're buying a startup. Why? Because you can't be in business without the inventory to sell, and you've got to have inventory to sell on the day you take over the business. Otherwise, you're out of business, right? Until you get more inventory. So if you have to go get more inventory produced, or you have to buy it from a source that's going to take 30 to 60 days to deliver it to you, that's a period of time you're not in business. What are your customers of that business doing? They're not going to sit around and wait 60 days to get their product. So they're going to go elsewhere for it, and you've lost them as customers. So all of the goodwill of a business literally disappears if it doesn't come with the inventory, because it means you're out of business till you replace it. Okay. So don't even think about buying a company without its inventory, because you're literally buying a startup. And all the goodwill value that they're trying to charge you for is lost, because they're showing you how much money they've earned in the past with the business. And they're saying, you buy this business, you're going to earn that income, right? And you're saying, well, yeah, so if I'm going to earn the income, then I can pay some multiple of that income as goodwill value for the business, because then I earn that money and I earn this profit. You can't do it if it doesn't come with the inventory. So hopefully that part is really clear. If the company has no assets but has cash flow, is it still a deal to go after? And here they refer to perhaps a janitorial commercial cleaning company, for example. So here's what they're telling you, okay, that the business has cash flow because there's a guy who sits in a closet and he takes orders for janitorial supplies or commercial cleaning, and then he outsources it to somebody else. And the whole activity is done on the phone because the business has no assets. Even there, I assume he's applying that it's a home business, right? So when you buy the business, you don't need any assets because you're going to have your own desk, your own chair, your own phone, your own internet connection, all of the stuff you need to do the business. But now you're going to do it at a closet in your house, right? So if a business has no assets but has cash flow, that's not a good business to go after, because basically what you're buying is not a business, it's a job, right? As long as you're in your closet doing your job, the business will bring in money, but then you're a slave to the business, because if you go on vacation, there's nobody there to do it for you. If there was somebody there to do it for you, you'd have to have assets for that person to do it for you. So it makes no sense to look at a business that has no assets, but has cash flow, but the cash flow is being generated really by the owner. And yes, it comes under the category of a janitorial commercial cleaning company, but it's all outsourced and it only produces income as long as you're working. Okay. That's called a job. All right. And maybe it's a good income job, but it's still a job. And when you go to sell it, you're going to have the same problem selling it, because you got to find somebody else who's going to buy the job. Okay. And you have no leverage there. Okay. You can't grow the business. It's not scalable. All right. You can't, I say, maybe I can hire somebody, but in order to hire somebody, you got to have capital. You got to have cash. Anything you do to grow a business requires capital to grow it. That's why businesses are part of this thing called capitalism. is you don't get to earn money in a business for free. Okay. Somebody had to put capital into it for it to grow. And capital means it has to have assets. All right. Doesn't have assets, it can't grow. In fact, one of the most important ratios of any business is called its asset to sales ratio. And what that's telling you in any given industry, how much assets or in effect capital you have to have in the business in order to achieve a certain sales size. So the bigger the business, the more assets it'll have based on the capital to or assets to sales ratio. So that's how people know how much cash or capital in a given industry has to be in a business. And by the way, that's another use of what are called RMA annual statement studies, where the Risk Management Associates Group produces for every SIC code in the United States, every NAA code in the United States, a relationship between that industry and their financial statements. In other words, different industries have different sales to assets ratios. Okay. And in different industries require different amounts of capital to grow the business to a different certain size. I'm probably giving you more information than you asked for here, but the important point that I'm trying to get to here is you can't buy a business without its inventory. Its inventory doesn't come with it. And if the price of the inventory doesn't fit well in the price of the total company so that you can make money based on the amount of purchase price that you're having to come up with, then it's not a good business for you to buy. You can't buy it without its inventory because then you're out of business. There you buy it. Okay. Hopefully that makes sense. All right. How is government policy affecting business acquisition? That's an incredibly good question. Let me do this, answer that question before I can go to the next one. Government policy is affecting business acquisition bad for small businesses. Why? Because the whole economic system is turned on its head right now against small business in favor of big business. You look at every policy that exists in government today, its regulation, its tax structure, all falls heavy on the small business and handleable by the big business. All right. And so if you're acquiring small businesses, that's a problem. That's why I'm not acquiring small businesses. If you look at the companies that I'm acquiring right now, the one we have a meeting on later today, the company has a transaction value of $750 million. Okay. It does 800 and some odd $1 million in revenue. Its EBITDA is around 65 million a year in EBITDA. And yeah, it's a big business, but boy, it's a whole lot easier to raise money for that company than it would be to raise money for a company doing a couple of $1 million a year in sales and making a few $100,000 a year in profit. And that's for two reasons. Okay. One is you can't get anybody, lender or investor, excited about investigating a company that I want to buy only to find out they can't make any money on it because the deal's too small. Okay. The bigger the deal, the more excited everybody gets, the bigger the people you can attract into the deal, the more hunger you can create in all those people to be part of the transaction because you got a company making a ton of money. All right. Compare that to a little company is making a little bit of money. Nobody's getting excited, very hard to do. Then when you acquire the small business, you got very little resources in the company to handle the government regulation, to handle the high interest rates, to handle all of the things that company has to deal with. And that company doesn't have the market power to make margins, to make effective margins. So with all of the stuff that they got to contend with. And then they're down in this rat race of highly competitive marketplaces where they got to grunt out a living if they can't. Big companies, capital, they've got the market power, they've got the excitement, they've got everything you need to get everybody excited. All you need is the financial know-how of how to put the deal together. Okay, because it's still not going to take any of your own money. In fact, the questions even get easier. For example, on a small deal, everybody wants you to guarantee your loan, right? So they loan you the money, but they want your personal guarantee. You want to establish credit with a new supplier, they want your personal guarantee. It's a nightmare. Okay. Whereas if you're buying companies, we do $500 million now, what are called mezzanine loans, and that they don't even think about asking you for a personal guarantee. It's unheard of. They don't do it. So all my debts are not personally guaranteed. Why? Because they're of a size and in a sophisticated enough marketplace, meaning the lenders are sophisticated. And everybody plays the game where they assume the risk that's appropriate to their particular loan or investment. And there's an interest rate they charge for that. But think about this. Suppose you're buying a company where somebody's going to loan you $1 million. Look at the vetting that they have to do to decide that you're okay for that loan. Look at the amount of profit they can make on this $1 million loan. It's small. Okay. Their margins have to be big. They have to charge you a lot of interest at a high rate in order to make any money on you. Whereas on a big loan, $500 million loan, they can work on very narrow margins and make a ton of money because the loan is so big. All right. So when they go to amortize their costs of vetting and validation and all that stuff, it's peanuts compared to the amount of money. They can be highly competitive, make a whole lot of money on what they do. And they're very happy to do business with you if you can be sophisticated enough to present it to them properly. So bringing it back to the question is, how is government policy affecting business acquisition? Very bad, because the interest rates are high. Okay. The regulations are imposing. Okay. And everything has been done to make small deals nearly impossible relative to bigger deals. So it's a policy oriented totally towards big business. So the deal that I'm trying to express to you is, if you're going to get into business acquisition, raise your sights a little. Look at how you can get into bigger deals as opposed to struggling with smaller deals. And I just want to say this: the reason people want to struggle with the small deals is because they don't think they deserve the big deals. That's for the big guys. That's for the elite. That's for whomever, not them. And it's not true. That's why Bizarre Financing is this key facilitator for you, because we show you all the secrets. Now, for those of you in Essentials, we've shown you enough that you know how these financial leveraging strategies work. For the pro folks, you know every which way from Sunday to pull this off. And it's a matter of you digging into that doable deal analyzer and that business price calculator to see what the right price of the business is, and how to put together all the financing elements, and how to do it in a way where the cash flow works for you, no matter how big the purchase. And then all the techniques and the methods are there. So if you're Essentials only, I do encourage you to upgrade to Pro, because you will get a way bigger ability to put together your bigger deals. Here was another question that came in the same vein. It said, government flooding the economy with liquidity, i.e. cash, how to use it in acquiring a business and how to access it. I think what this person meant by this is that the government is either spending tons of money or has been spending tons of money, putting all this money into the economy, which has now caused inflation. But the money is out there, the liquidity is out there, but how do you get it? And how do you get it into your business? How do you access it? Okay, you access it in the same ways that it's always accessed. There are lenders out there flush with cash. They're called banks, insurance companies, pension funds. Okay, they love to loan money. They love the new higher interest rates. They love putting that money out, but you got to give them a business plan, right? So how do you access it? You go to a mortgage broker to get access to insurance companies and pension funds. You go to investment bankers who have access to investors and all kinds of other lenders that they can bring you into. But when you go to them, you can't go to them naked, right? You can't go to them and say, I'd like to borrow a lot of money, or I want you to invest a lot of money in my, because no one will pay you any attention. Okay. So what do? You have what's called a CIM, which is a confidential information memorandum, or you have an executive summary or a business plan, or you have any one of a number of different things that show them what you're going to do that's going to produce so much profit that you can easily give them a phenomenal return on their investment, or pay their high interest rate and do it comfortably, where your cash flow on a pro forma basis going forward, taking your history and then take the company and then projecting it forward, you're going to show them how you're going to be able to give them their money back, plus a very high return in either interest or equity participation. And you've got to be able to put that together. Okay. You've got to be able to do it. In Bizarre Financing Pro, we show you exactly how to do it. There's chapters on it, on each one of those. And there are tools that are in there that help you to figure it all out and to be able to show it to all the different parties that you have to show it to. And the objective is for you to put together an executive summary that section by section tells the investor, tells the lender, everything they got to know in how, in loaning or investing the money in you, their money is relatively safe, relatively low risk, and high rate of return, and how the resources are there that give them the comfort that this business can do what you're projecting it will do, who the management is, why they're qualified. Okay, all of these things are important. Now, if you're buying this little tiny business, who's qualified? Probably nobody. The people who are qualified are probably leaving because they're the seller. So then there's you. How do you prove you're qualified? I never worry about proving I'm qualified, because I buy a business big enough to attract top management talent. Okay, so I find out who top management is. I show them how I'm going to give them a piece of equity in the deal. If they're part of the company already, I show how they're going to love staying on with me as their partner because I'm going to give them an equity in the equity interest in the business. But you got the proven management talent there to do it. And if I don't have the management talent in the business, I'll research the hell out of the marketplace, find top people in the industry, and give them an incentive to come be my minority partner in my purchase. I'll give them a big piece of equity in the deal. And they don't have that where they are right now, but their management skills and talent and resume is superlative. So now I can prove to my lenders and investors that I'm going to be able to give them a very pleasant experience loaning or investing the money into me and my company that I'm about to acquire. So yeah, the liquidity is out there. It's all over the place, but it's not available to you unless you go at it in the right way. But once you know how to go at it in the right way and you pull together all those pieces and you present it to the parties that have access to the money, and they don't hide, by the way, they're out there. In fact, if you go into your Bizarre Financing website, you go to the research center there, you'll find that there are links there to every single type of entity that is there to finance your type of business. And it'll take you right to their websites. Okay. You'll see exactly what they do. And it's all by category from every type of lender and investor that there is. There's a section there and you don't need to be part of Pro to get that. You have access to that through Essentials. So all that is right there for you and you can go to it there. How to get that cash given to others into the business you're buying? I guess I really just answered that question. You've got to show them what you got. And you do it through certain types of documents, whether it's an executive summary, a business plan, a CI. We even have designed our letters of intent to a seller where we're telling them now what we're going to do, the terms of the transaction, everything. We have an introduction that lays it out, who we are, what we do, why we're the best people on the planet for them to sell their company. It's all the first page of the letter of intent. But you remember, you think you're buying businesses, but you're really selling yourself. You're selling your ability and your team's ability that you've put together to do this. You're selling the ability of your group and to pull off this acquisition and that you have either in the company already or part of your group, the management capability that proves how to run it competently, right? And that you've aligned all of your business purchase elements to give them a high return with limited or no risk. And you've structured the deal in ways that they're going to feel comfortable with it. So again, if you have any questions about how to do this, if you're Essentials, you go back into those models that we gave you, go back into the past webinars that you have access to, because all of this stuff is in one place or another explained, and you have the opportunity to just reinforce it in your head. And if you want to put that knowledge on steroids, just be part of Pro, and you'll have that same information, but at a whole nother level that will give you much more options on what to do and how to do it, et cetera. So hopefully that's a little helpful here. Now here it says how Fed quantitative easing is an ally to the leverage buyout buyer. Okay. Now it's an interesting question because they're not doing quantitative easing anymore, but they're doing the reverse. But let's just take a look at something. A lot of times people will ask a question and it's because they don't fully understand all the terms that are involved and what those terms really mean. So no matter how sophisticated I've ever gotten to myself, I'm a big user of Google. Okay. I'm a big user of the internet to go research any term or anything that I'm not 100% sure about. Okay. So when I go on to a search engine like Google and I put in quantitative easing up in amongst their responses to my query, they'll refer me to websites. And here's one website that they referred me to. And if I go into that, it comes up with an explanation of what quantitative easing is. And then it will also give me some understanding of what it is, how it works, and all of that. So let's just take a quick look at what quantitative easing is. Quantitative easing is a form of monetary policy in which a central bank, like the U.S. Federal Reserve, purchases securities from the open market to reduce interest rates and increase the money supply. Quantitative easing creates new bank reserves, so your bank has more money to put out in loans, providing banks with more liquidity, i.e. the cash to make loans, and encouraging lending and investment. Okay, in the United States, the Federal Reserve implements quantitative easing policy. Right now, that's not what the central bank is doing right now. What the central bank is doing right now is they're raising interest rates to make borrowing less attractive and harder for you to use borrowed money to buy anything, including a company. So right now, it's not quantitative easing that's happening. It's increasing in the interest rates, which are making businesses less valuable. All right. And think of it this way. Okay. You got money to put into some kind of an investment. You want to get some kind of a return. If you can put money into government securities and make 3, 4, 5% on your money, you can put some money into investments in into federal debt instruments in low amounts, but where you can earn 2 or 3 points over the rate of inflation. So those are paying 9, 10% right now. Okay. But you can't do a lot of that. There's a limit to how much they'll let you do of that. The point is that the higher the return you can get on money you put into safe government investments, the less likely you're going to be investing that money into businesses where the values, if you look at the marketplace, the stock market, those values are going down. So why would you be investing in businesses whose values are going down when you can invest it in a safe investment where you're going to get a decent return on your money? Okay. So the higher the Fed cranks up the interest rate, the more that becomes true. The lower the value of businesses, the lower the value of the stock market, and the less likely that people will want to invest in a business when they can put the money in something safe and still earn a decent return. So as long as they're keeping to hiking interest rates, the values of businesses are going to come down. Okay. But it's going to be more expensive to buy them because if you're using borrowed money to buy them, your interest costs are going up. However, this is a great time to be buying businesses. And the reason is because as the interest rates go up, it costs you less to buy the business. If I buy a business today at high interest rates, the cost is about the same to me as it would have been had I bought the company when it was low interest rates, but the price was higher. But guess what? When I buy it when the price is low, that's forever. And so a year or two from now, when interest rates come down again, I can refinance and I bought the business at a bargain and my interest rates are fine for the value that I paid for the business. Okay. Because I refinanced when the rates come down, as opposed to if I bought it when the cost was higher and the interest rates were lower, I can't refinance it. Right. Because if I refinance it now, I pay higher interest rates. Okay. And and when the rates come back down, I don't have to refinance it. I already got a low interest rate. So I didn't accomplish anything. Okay. When the business price was high, except pay a high price for the business. But if I can buy now, I can buy at a low price and then refinance when the interest costs come down. It's a heck of a lot better deal when I buy now. When I go back to the original question of quantitative easing, when that was the case and it was quantitative easing, what was happening is that the marketplace was being flooded with liquidity. So I had all these folks out there when interest rates were low that wanted to loan me lots of money to go buy the businesses. All right. And so if we ever have quantitative easing again, which I don't see happening for the next 10 or 20 years, but when it happens again, and it's sometime in the long-term future, it will, then that's the time that I want to go buy businesses like crazy because I'm going to have low interest rates and a flood of money out there looking for something to do. So it gives me the opportunity to do this productively. But for the people who understand what's really happening right now, I'm going to go out, I'm going to buy the business at a low price. I'm going to borrow the money at a high price. I'm going to make sure that the cash flows will sustain the business through this period. Okay. That I want to make sure that the cash flows are going to be adequate, enough profit in the business. But then I've got a hell of a bargain once the interest rates come down again, whether it takes a year, 2 years, 3 years, 4 years. At some point, that interest rate's going to come back down again. And when it does, I'm going to refinance. And now I got myself a hell of a bargain that I paid for the business. So that's the nature of where we are. So hopefully that helps everybody to understand that process, including when you have any question about what something really is, go do your Google search, find the right website, go in and get your information, and you'll make better decisions when you use that process. Says, why can heavy borrowing now be smart money management? I guess I just explained that. Borrow money now, you pay a high interest rate, but business values are low now because of the high interest rates. And so you're able to make a bargain purchase of the business at today's pricing. And then when interest rates come down, you are refinancing at that higher rate. Here's another good question. He says, if I buy a list of businesses in a specific industry, what should be my next step what should be my next step to determine which company has the right buy criteria before picking up the phone? It's not a great question in the way that it's worded, but I'll try and give you what's a good answer, and maybe by helping you re-understand the question. So the first thing is, what's your criteria for buying a business? Okay, because it says company which has the right buy criteria before picking up the phone. Before picking up the phone, you may not know those answers, so we're going to have to be a little careful of that word. You pick the phone, but the first thing you got to do is have a criteria. What makes a good business for you? Okay. And the criteria is it's going to have a certain amount of revenue, a certain amount of earnings before interest, taxes, depreciation, and amortization. So a certain amount of earnings, of net earnings, profitability, cash flow. It needs to be probably in a certain location. It needs to have at minimum of a certain amount of assets. And the asking price has to make sense in light of all of these other things right here. So you're going to develop a criteria around these essential elements right here. Okay. Now let's talk about what your criteria is going to look like. All right. Number one, okay, you're going to have a minimum. And if you're good at what you do, you're not going to have a maximum, but you're going to have a minimum. All right. And my minimum for right now is $20 million a year in revenue. If it doesn't have 20 million a year in revenue, I don't even look at it. Now I will make an exception. Okay. Cover in a minute what warrants the exception. All right. And the reason I have this minimum of 20 million is I can't get anybody excited today about a company with a transaction value or a revenue out in the company of 20 million. And as far as the EBIT is concerned, it's got to have at least 4 million of EBITDA. Okay. So if it doesn't have 4 million of EBITDA, I don't look at the company because there isn't enough profit in the deal that when I multiply the EBITDA times a reasonable multiple of, let's say, 5 times 4 is 20. If I don't have at least a $20 million deal, nobody who can handle the lending or investing of big money is going to even talk to me. They're not going to want to know from that deal. The location is important because do I want this right near me so I can run it easily? Or is this going to be part of something bigger where I'm going to have this great management team in place and the location can be anywhere in the United States? See, I got to have that as part of my criteria. And then again, depending on the industry that I'm choosing, because it says specific industry up here, then how much assets it has in the business is going to be important, because if it doesn't have the assets in the business to support the existing revenue and EBITDA and its growth into the future, then I got to have a certain minimum here. And then I've got to have an asking price that enables me to work with these things here, the revenue, the EBITDA, and the assets, that I can meet the asking price and especially the terms. Okay. So asking price, and probably I should have the word and terms after asking price. Okay. All of this has to be built into a criteria that before I pursue the company, so I'm not saying picking up the phone, but before I pursue the company, it meets these qualifications. Now, I said there would be a difference in revenue and EBITDA under one set of circumstances. Right now, I'm buying companies in the jet charter field. Okay. Companies that are either what are called brokers, meaning they're marketers. They sell jet time, but they don't operate any aircraft. They sell the jet time on other people's aircraft. And then the other part of the industry are what are called operators. They operate their carriers. They actually have jets that they either own themselves or they have contracts with their clients to manage their jets and put their jets into this marketplace for jet charter. Okay. And it's done by contract. So they're one or the other, and I'm buying those companies. But some of the companies I'm looking to buy are small. And I say small, maybe you're doing 5 to 15 million of revenue. They're not up over that $20 million mark, right? But I want to look at them anyway. Why? And their EBITDA is maybe flat, or they maybe they only making $1 million or $2 million in EBITDA. Okay. But I still want to look at those companies, and I'm still going to buy some of them. And why? Because I found that some of them have developed technology, intellectual property, that when I combine it with another piece of intellectual property that I'm using to make these jet charter and operator and broker companies way more profitable, it's called scale. I'll talk about that in a moment. But when I'm buying those companies, okay, I'm buying with it a piece of technology or intellectual property that when I add it to the technology I'm already using in my acquisitions of these other companies, that it will have a much bigger beneficial effect for every acquisition that I'm making. All right. So it's a technology play. It's an intellectual property play that makes other things I'm doing more valuable. So that alters my criteria for that category of company that may be small, but has some intellectual property or piece of technology that when added to the technology I've already brought into these industries, it makes everything more valuable. So that's my criteria. Okay. And that is what you're looking at before you actively pursue the company. So this should be modified up here. This statement should be modified to say something more along the lines of, once you have a list of specific businesses, you have to do a minimal of due diligence on each company, which will require you pick up the phone and call them and talk to the owner and discuss with them the possibility of your buying their company. Okay. But then you're going to get from them financial statements. You're going to give them enough statements about what you're doing and about what you're willing to do with them that you motivate them to at least send you a set of financial statements to further discuss the value of their company to you. And then from those financial statements or for financial information that they will give you by phone if they won't give you the full financial information, you at least determine these numbers here. Okay. And then determine from that if you want to then pursue it further. Okay. So it's not about picking up the phone. It's about after you've picked up the phone, you've talked to the seller before you pursue them. This is the criteria. You want to make sure that you've set out a criteria that they meet. Now, the next step, as I mentioned earlier, is getting those financial statements for the last several years and the most recent quarter. But you can do it even without these if you just ask them, what kind of revenue do you do each year? What's your net profit for the year? How much money does the business cash flow for you? What assets do you have? Do you have jets that you own? What jets do you own? What values do you put on them? If I were to give you an asking price, your asking price for this business, what would you want for it? And then they say to you, I don't know, make me an offer. And that's all good because you'll figure out what's a good price for you to make them an offer at. And then that's where the whole discussion begins. And depending on the reception that you get and your ability as a negotiator, you'll decide whether or not you want to use the phone to talk to them or more and to pursue the business. Hopefully I've given you a kind of a sense of how you deal with the concept of what do you have to have in order to pursue it. You have to have a criteria and the business has to meet your criteria for the most part before you go into the real pursuit of that business. Okay, here was a question I'm surprised I got. Okay, some teach as a buyer, you should build rapport with the seller before meeting them face to face. But don't you teach not to meet the seller in person because it could kill the deal? Please explain. It's the reverse. If you go back to your essentials illustration of how I bought my first business, you'll remember I stress building a cosmic bond with the seller, of getting to know the seller, letting the seller get to know you, finding the things you have in common and making those the basis of building rapport with the seller. Get to the point where you actually like, trust, and respect each other. It's really important because you can't do business with people you don't like, trust, and respect. They won't do business with you. And remember, you're going to be taking over their child, right? That they've nurtured from infancy where they built it in their garage and finally made it into something of substance. And they're very proud of it. And they don't want just anybody to take it over. They really are concerned with its future success. And even in fact, your willingness to keep the business functioning in the culture and in the way that they built it. Okay. That you're going to take care of their employees, that you're going to take care of the community that they built it in, and that you're going to make the right decisions for all of the constituencies that have an interest in their business now. All right. So all that's important. So just remember, this is not it. Okay. It's the reverse. The whole idea is to recognize that a business, the sale or purchase of a business is first and foremost a psychological transaction before it is a financial transaction. You've got to get through the psychological side first. And that means building a rapport. Now, some people say there are plenty of people who buy businesses and they do big deals and they never do this cosmic bonds thing. Yeah, it's true. They don't. But what they do is they roll in with a bushel basket full of money and the money speaks, right? But you don't have a bushel basket full of money, so you can't do it that way. You do it through personal power, not financial power. You do it through personal power of building rapport. You do it by creating an environment where the seller wants to sell for you and he'll lean in or she'll lean in order to make it happen, where you're all going to collaborate together to make it happen as opposed to not make it happen. And then your knowledge of Bazaar financing is going to handle the financial side, but you can't do what the big guys do, which is roll in with their bushel basket full of billions to get a deal done. Okay. Nor do you want to do it that way. It's the reverse. Yeah, here was another question I thought was pretty cool. It says, I'm looking at a company with an asking price, I shouldn't say asking price, of 1.5 million and cash flow of 260,000. How important is the difference between these two numbers? The difference between them isn't what's important. It's the size of them that's important. Okay. The 1.5 million of asking price, okay, and the cash flow of 260 are related. Okay. Because if this number is more than five times this number, you're going to have a hard time paying for this company. Okay. Unless it's growing at 15 or 20% per year. And then the growth of the it will eventually, in other words, at the speed at which this number is growing here, the cash flow, if it's growing fast enough, then the five times this will pay for a bigger number, will pay for a bigger number than five times. It'll pay for six times. What is this? This is, if this was 250,000, just for ease of calculation. If you've got 1.5 million, but it's cash flowing, I'm sorry, purchase price, but five times 250 million, 250,000 5 times 250,000 would be 1.25 million, right? Okay, because four times that would be roughly that. So if this is five times this, let me just take five times this. 5 times 6 is 30. 2 times 5 is 10. So it's roughly 1.3 million. So you want to get this number down to about five times this, unless the business is growing faster than at 20% per year or more, sustainable. Okay. So that's the relationship between these numbers. How important is the difference between these two numbers? So let's say it's very important, the difference between these two numbers. Let's say it is, because this number should not be, this number shouldn't, of asking price should not be more than five times this number, unless it's doing over 20% growth per year. Why is it important? Because it's from the cash flow that you can make the payments on the purchase price. So if you take the value of money and your interest cost on the money, and for the part you pay to investors, because that's your loan, is your interest on the portion of this loan. But on the portion that's equity, meaning that you went out and you got from investors, they're going to want to see a 20% to more per year return on your money. Okay. So if this number isn't at least five times this number, you're not going to be able to make the payments on your interest, your return to your equity investors, and your amortization of principal on your loans. Okay. You're not going to be able to do it. So that's why the difference between these two numbers is important, in that it's not more than five times unless the company's growing at 20% per year, because then the cash flow is growing at such a high speed that you'll grow into your ability to pay off your loans and your debts. Okay. But if it's not growing at 20% per year and you're paying more than 5%, five times earnings for it, or five times cash flow, can't do it. Okay. So that's why it's important. Okay. Also, is this where you get the EBITDA? Yeah. The EBITDA is another way of really defining your cash flow. So if you take your earnings and then you're taking those earnings before you've taken out your interest cost, before you've taken out any taxes, before you've taken out any depreciation, and before you've deducted any amortization from it. So that number is this number here. Okay. That's here. And then where's your cash flow going? Some of it's going to go into taxes. Some of it's going to go into depreciation, which will not be against your cash flow because depreciation is a paper expense. It eventually catches up with it where you have to replace the equipment. And then there's amortization on your loan. So this amount here is where the money comes from to pay your interest, your taxes, cover your depreciation, mainly in the form of laying money aside for future purchases, and then the amortization of your existing loans. Excuse me. Okay. So that's what this number and this number tie together. What is your preferred method for a direct approach to potential sellers? All right. You're going to love this. Okay. Because we do this now every day. Every day I train a team here to do this. We call jet charter companies that are either brokers, they sell jet time, or they're operators. They provide the aircraft to fulfill the sale of the jet time. And we contact them every day. And so what we do is we research them. Okay. We found lists of where I've identified every single one of those companies in the world, not just the United States, in the world, where they're an operator. I know how many aircraft they have from this list, how many aircraft they have, the tail numbers of all those aircraft, the make, the model, and the age from which I can figure out the approximate cost or value of the jet, how many dedicated pilots fly for them. It's got a host of information about these companies. All right. And it tells me who the owner is, where they're located, their phone numbers. I got everything. All right. And then I train people how to contact them. And the way that we contact them is we have emails that we send to them. We have letters that go out on actual stationery that we send to them. Those letters explain to them this one simple fact. Okay. And you're going to love this. These letters and all of this information points in the same direction. Basically says to them, we have $14 million of charter time that we need purchased for our client. If you're interested partnering with us to handle that volume, we would like to speak with you. Now, there isn't a person there isn't a business owner that we send that email or letter to that wouldn't love to have another 12 to $14 million worth of volume added to their volume this year. They'll call back or they'll have somebody call us back. And then we train our people how to take that call back and convert that into an interview between myself, the key person who's our CEO or president of our company, our purchasing company. And he and I get on that go to meeting with them. And we show them what we're doing in partnering with people in this business, which takes the form of an acquisition where we pay them upfront for the company, all the cash that we could justify its worth today, and then allow them to be our partner in the growth of their company, which they'll continue to run. And in 3 to 5 years, when we IPO, it shows them how much money or how much equity they'll get in the IPO. And so it's a formula, it's a process. Almost nobody says no to us. We've got it refined down to that place. But what we don't send them is a letter saying, I'd like to buy your business. Are you interested in selling? We send them something that we couldn't produce for them. We can produce it, okay? Because we have companies that we're buying now that have this surplus business that they'll need to have placed for them. Okay, so when we call or communicate with these people, we're telling them something we can actually do for their company. We then move it to the bigger agenda of what we want, which is not only to bring this capacity into the company, but to then have literally a partnership with them where they'll continue to run the company. We'll handle the financial growth of the company, all of the needs of financial growth. And they will also get a big piece of equity in us in addition to the cash buyout that they're going to get for what the company is actually worth in dollars today. But that's our method. Okay. Our method is the direct approach to those folks. You know who they are, and it's the law of numbers. For every inquiries that you send out, you're going to get X amount back. And we're shocked at how many we get back. It's running about 40%. So 40% of we reach out to, they're willing to have the next series of talks with us. And what we found is of those, 80% are saying yes to a letter of intent. So our numbers are awesome doing that. But we know our game. We know what benefits we bring to them. We know their pain points, why they're interested in selling and why they're interested in being part of something bigger and better. Most of them are boomers. They need an exit strategy. So they're already predisposed to really talk with us. Anyway, we got it down pat. Okay. But the answer to the question is we take our list, we refine it based on our criteria from the information we know about them. We reach out to the ones that we're interested in and we approach them with how much business we have that we're looking for somebody to handle for us. Nobody says no to that meeting. Nobody says no to the second meeting once we bring in the bigger picture. So anyway, that's what we do. What would be your instructions on the use of handwritten letters? I don't like handwritten letters. Why? Because they're hard to read unless you've got great penmanship, number one. All our letters go out typed on great stationery. The stationery looks like we're worth $1 bazillion. And a lot of it goes out on emails. But it's important that you look good from whatever you send out. You've got to have a professional look to yourself and a look of substance. But handwritten, it should be hand signed, but not handwritten. Can you explain what you meant by using DBMs to annihilate competition? We took these questions just as we found them. I don't know what they meant by DBMs. DBMs in the world I know is database management. And we don't use database management to annihilate the competition, but what we do use to annihilate the competition is a product that we have. It's a platform that we have called Scale. And I'll explain that to you in a minute. But basically, what it does is it's more of I guess you would call it database management. You might, but basically it's a way of organizing companies to be highly more competitive. I'll cover it with you towards the end because we had another question that will bring me there. Another question we have are, what are zombie companies and how can you find opportunities with them? Well, the first time I heard zombie companies, I didn't even know there was such a thing as a zombie company because I don't work with marketplaces that, as it turns out, would have zombie companies. So I do my usual thing. I go to the internet and lo and behold, I Google it, zombie companies, and I got something that brought me to Investopedia. And it says, what are zombie companies? Okay. Zombies are companies that earn just enough money to continue operating and service debt, but are unable to pay off their debt. Such companies, given that they just scrape by meeting overheads, wages, rent, interest payments on debt, for example, have no excess capital to invest to spur growth. Zombie companies are typically subject to higher borrowing costs. Why? Because they're not profitable company. And maybe one just event, and maybe just one event, market disruption or a poor quarter performance away from insolvency or a bailout. Zombies are especially dependent on banks for financing, which is fundamentally their life support. Zombie companies are also known as the living dead or zombie stocks. All right. Now, everybody should now know what a zombie company is, and everybody should now know why it's bizarre financing. These aren't the companies you want to chase. Leave these for the bottom feeders. Okay. Leave these for the folks who don't know better and are trying to get their hands on a company that they can buy cheap. The only problem is you buy it cheap, then you don't have anything worthwhile. Okay. And then you got to make something out of nothing. So I don't see any advantage to even buying or even thinking about buying a zombie company unless it's a company that just happens to be struggling, but it's got some resource or some asset that if you could redeploy it in other things that you own, then it has value. So that would be a reason maybe to go after what would be a zombie company. But I would just say, ignore them. This is not the place you want to be hanging out. So that's my immediate reaction to it. How can you find opportunities with them? The only opportunities that I really know of is if you can put a couple of them together where each is weak in the area where others are strong, so that when you put them together, you can eliminate all the weaknesses and only have the strongs left. If you can pull together something like that's a lot of work to chase profit. That's maybe. Go after the profitable companies, folks. Don't be scared off by the fact that the big boys and girls chase the profitable companies. They are the ones with all the money. They are, but they're busy and they got lots of companies to go after. You're going to find one or two that they're not chasing right now. And if you have your bizarre financing stuff down pat, then they're the ones to go after because you'll get lots of help from the financial community if you do it right. Okay. The last question that I think I have here is what is Scaleforce and how to join it? Now, this is where I mentioned this earlier on the DBMs, database management, because it's not really database management. Scaleforce we've rebranded it as Scale. So that's what it's now called, Scale. And basically it's a cloud-based technology platform for strategically aggregating companies which provide related services and products to essentially the same customer base. So what we're doing with all of these jet charter companies that we're buying, in addition to very profitable companies that, guess what, have lots of ultra high net worth individuals as their clients, people who can afford to spend $10,000 an hour to fly themselves someplace and don't bat an eyelash about it. And in fact, when everybody else is worried about inflation, these people don't care. It's pocket change to them. An ultra high net worth individual is somebody who is, by definition, has 30 million of liquid capital in their bank account or in liquid investments at any given moment in time. Okay. And guess what? There are over 500,000 of these people in the world. Almost 200,000 of them live in the United States. So it's a big market. And these folks have spending power of over $6 trillion among them. Isn't that a great client base? And guess what these people all have in common? They love spending their money. They spend money whether other people are spending or not. No matter what the economy is, they got money to spend always and forever. Okay. That's what makes them unique in the marketplace. And what do they spend their money on? They spend their money on jets. They buy them. They charter them. Okay. But they also spend money on security, physical security, internet security, facility security, personal bodyguards. They spend money on yachts and either to buy them, charter them. Okay. They spend money on exotic cars. They spend money on fabulous homes in the state. They spend money on jewelry. They spend money on vacations, renting an island. Okay. Or buying the island because they want to go back year after year. These people have incredible money and they all spend it in these very exaggerated ways. Guess what kind of companies we're aggregating using Scale? We're aggregating these companies that are all these companies that provide these wealthy people. And then one of the things that these wealthy people do is they typically have a family office to manage and handle their affairs. All right. And so in those family offices, we are providing and embed a certified concierge professional that works with the Scale platform to seamlessly integrate all of the needs of these wealthy people through the companies that we're buying. So we're buying yacht brokers, we're buying security firms, we're buying exotic car dealerships, buying real estate brokerage companies that specialized in the very high end properties. Okay. We're buying other types of companies that cater to these types of individuals. All right. And then we cross market through Scale the client base of every one of these companies that we buy for all the other products and services that their clients are spending money on. And it's an incredible process by which you multiply the amount of money that's made by every one of our verts. We call them verticals. Each is a different vertical that we're buying and then cross marketing. It also, the system, it also automates the cross marketing and revenue sharing process. So it's all seamless. Everybody's on the same system. It's totally transparent. If you're the user, i.e. the wealthy person, from your cell phone, you can see what we call the service pillow to pillow. So from the time you get up in the morning, you'll be able to track everything that's going to happen to you. And as it happens, interactivity with it, everything that's going to happen until you put your head down on the pillow at the end of the night. So if you have a limo picking you up, you'll know who it is, what the car is, who your driver is going to be, when they're going to arrive. You'll know all of that stuff. Then if they take you to the hangar, you're going to know what hangar you're going to. You're going to have a greeter there to meet you who's going to take you onto your jet, introduce you to your crew. Your crew is going to be operating a plane that has been provisioned for you just the way you want it provisioned. It's going to be taking you to the destination that you want to go to. It's going to be delivering you to a limo. That the same thing, information, you'll know who it is. You'll know that they're there. You'll know that they're ready to pick you up. And they'll take you to your final destination. And everything it took to orchestrate and handle that trip will be done through the system with total transparency. And it makes the whole system easy, including if you have security that takes you to the plane, if you have security that picks you, that flies with you on the plane, if you have security that meets you at your destination and works with you in and through your hotel or wherever else it is that you're staying, everything gets coordinated through this system. And so that if you're a wealthy person, for ease and safety and convenience and sheer service, there's nothing that beats the system. And it automates and standardizes all of the process to scale for growth of every one of our verticals. So it takes and breaks down into standards, into forms, into everything that it takes to do this. It takes anybody who has to do anything and puts everything they has to do at the touch of a button that pulls up the form, that handles the situation, that sends out the emails, that does whatever has to be done to do what has to be done. And all of it is done using automation to do it, except where you need that physical integration with a person. So our certified concierge professional is that person that will always be available through your phone, through everything to make sure that anything you need to happen, anything that isn't coming together the way it was supposed to, it's a real person who you have to talk to, who can use the system to straighten it out in a hurry because they're connected. The system is connected to every one of our providers to make this literally seamless. So anyway, that's what that is. All right. It's 2:53. I've got another meeting I have to be on literally in 7 minutes. I'm amazed. There's still a whole bunch of you left as long as this has been.